National CineMedia, ticker NCMI, missed Wall Street consensus on both the top and bottom lines for Q2 2026. Actual adjusted EPS came in at negative 10 cents.
Right, and GAAP EPS was negative 11 cents, so they missed that negative 9-cent consensus estimate.
Exactly. And the top line wasn't any better, Actual revenue was $58.4 million, missing the $59.34 million consensus.
Yeah, and then management officially paused and just suspended all near-term forward guidance.
Which the market absolutely hated. The stock cratered immediately. It crashed over 37% during regular trading.
Wow.
Yeah, and it extended to a 41% loss after hours, hit a 52-week low of $2.22, and basically wiped out nearly half of its market cap in one shot.
It's just a brutal reaction.
So our mission for this deep dive is to figure out why. We're going to analyze the underlying segment performance, decode the management commentary around this massive new acquisition, and really break down the notable balance sheet risk that triggered this collapse for you, the retail investor.
Because, if you just look at that headline drop, you'd assume the core business is completely dead.
Right. That's the natural assumption.
But if you actually dig into the operational metrics, it's not dead at all. It's actually surprisingly robust.
Yeah, let's bring those numbers into focus, because despite missing Wall Street's exact targets, total revenue was actually up 12.7% year over year.
Yep, up from $51.8 million in Q2 2025.
And you have to look at the profitability, too. Adjusted OIBDA, so operating income before depreciation and amortization, saw this massive 200% improvement.
Which is huge. They hit $2.1 million compared to just $0.7 million last year. So margins expanded from like 1.4% to 3.6%.
Driven by real foot traffic, by the way. This wasn't some accounting trick. Network attendance surged 19.3%.
Wow, so to what, like 137 million?
137.6 million, exactly. Driven by the strongest Q2 box office since the pandemic. We had massive blockbusters like Super Mario Galaxy, that Michael Jackson movie, Michael and Toy Story 5.
And that attendance is everything for them. NCM's entire product is basically just monetizing the audience's attention before the previews roll.
Right.
And they monetized it really well in specific areas. Like local advertising was a standout. It grew 48.4% year over year to $9.5 million.
Which is incredibly hard to do, right? Local ad sales require an actual boots-on-the-ground sales force.
Exactly. You need people out there convincing regional businesses to buy screen time. Programmatic ad revenue also grew by 45%.
And management was cutting costs at the same time. They delivered $2.7 million in savings year to date.
Meaning they're perfectly on track for that $11 million annualized goal.
Okay, let's unpack this. If attendance is up almost 20% on the back of these global blockbusters, and local ad revenue is surging, and programmatic is up 45%.
Right.
How exactly did they miss the top-line consensus? Where is the disconnect there?
Well, it really comes down to headwinds that pressured their advertising yield. So first you have to look at what was actually playing in June. The film slate was incredibly heavy on horror.
Like the Obsession and Backrooms movies.
Exactly. Huge hits, massive attendance, but horror is notoriously difficult to monetize.
Wait, let me push back on that. Horror movies pull that 18 to 35-year-old demographic, right? That's like the holy grail for consumer brands.
This is the holy grail, yeah.
So are you telling me national advertisers are just so sensitive that they leave that highly profitable audience completely unmonetized?
Well, not completely unmonetized, no. But they refuse to pay premium upfront rates for it.
Ah, got it.
It's basically a strict brand safety mechanism. Blue-chip national brands like your major automakers, telecom giants, banks, they have these really rigid parameters programmed into their media buying.
Like a family-friendly brand doesn't want its logo next to a slasher film.
Exactly. They won't allow a commercial to play in a dark theater right before a terrifying R-rated psychological thriller. So NCM gets the physical eyeballs, but they're forced to sell that inventory on the remnant market.
At massive discounts, I assume?
Heavy, heavy discounts.
Yeah.
So the yield per attendee just tanks.
So they have the volume, but the quality of the media environment forces them into a lower pricing tier.
Right.
That makes sense. What was the second headwind?
The 2026 FIFA World Cup.
Oh, right.
Yeah, marketing budgets for global brands are generally fixed for the year. So when a massive event like the World Cup happens, brands aggressively reallocate their national ad spend.
They pull it from places like cinemas and dump it into live sports.
Exactly.
Right.
So NCM was basically fighting a war on two fronts. A movie slate that triggered brand safety discounts, and a global sporting event that vacuumed up whatever premium ad dollars were left.
Which is such a structural vulnerability. And that is exactly why management announced this radical strategic pivot right alongside the earnings report.
They had to. Being entirely at the mercy of Hollywood's release calendar and global ad trends is brutal.
Right, so they announced a definitive agreement to acquire Captivate Holdings for an enterprise value of $275 million.
Which is a huge move for them.
It is. Captivate is a leading operator of digital out-of-home video advertising. But specifically, they're in elevators and premium office lobbies across North America.
So this scales NCM's reach dramatically then.
Dramatically. They go from roughly 22,000 cinema screens to this combined 48,000 screen premium video platform. And it spans 185 designated market areas.
Wow.
Here's where it gets really interesting. NCM is basically hedging their bets against the movie theater business itself.
Oh, for sure.
Right. Instead of only monetizing you, the consumer, when you're trapped in a theater seat with popcorn, they're now targeting you in your office elevator on a Tuesday morning.
Or your apartment lobby on a Thursday night.
Exactly.
And, it fundamentally changes their value proposition to media buyers. They're evolving from this destination-based ad network to a continuous daily touchpoint network.
Which completely bypasses the horror movie problem.
Yes. If a buyer is hesitant about the June movie slate, NCM can just say, hey, how about these premium lobby screens and commercial real estate instead?
Because it's predictable, brand-safe foot traffic.
Exactly, regardless of what Hollywood is putting out.
Let me stop you there, though, because we need to critically evaluate these assets. You're trading a 60-foot screen with a captive audience and surround sound
Yeah.
for a 15-inch, probably muted screen in a fluorescent elevator where everyone is just staring at their phones anyway. Does that actually translate to pricing power with advertisers?
Well, that's exactly the debate happening among analysts right now, because the engagement models are totally different.
Right, immersive versus ambient.
Exactly. Cinema advertising is high-impact, immersive impressions. Captivate is high-frequency, low-friction impressions. But from a programmatic standpoint, advertisers love the data and the ubiquity.
Because the Captivate screens are in Class A commercial real estate.
Right, which guarantees a highly affluent professional demographic.
Yeah.
So NCM's thesis is, if we bundle high-impact cinema ads with high-frequency elevator ads, we can offer a cross-platform campaign with a much higher blended yield.
Strategically, I get it. Escaping the Hollywood roller coaster makes total sense. But strategy is completely useless if your capital structure collapses underneath it.
Oh, absolutely.
And that is exactly why the stock suffered a 40% haircut. Because for a company whose market cap shrank to roughly $208 million, acquiring a $275 million asset comes with severe balance sheet risk.
Yeah, the market reaction was driven almost entirely by the financing mechanics of this deal. This Captivate deal is 100% debt financed.
100%.
Yes, entirely through a new high-interest secured term loan.
Which is a violent departure from how they've operated. Going into this quarter, NCM had a virtually debt-free balance sheet.
Yeah, they ended Q2 with $46.1 million in cash and only $12 million in debt.
Net leverage ratio was just 0.39x, basically nothing.
Right, but post-close, which is expected in the second half of 2026, the combined entity's net leverage is going to skyrocket to 3.9x.
That is insane. To service that massive new debt burden, management suspended the dividend and paused the share repurchase program.
Yeah, the dividend is gone.
And I just have to point out the irony here. They paused the buyback right after they recently bought back roughly 63,000 shares at an average of $3.10. And now the stock is sitting at $2.22.
Not great timing.
No. But let's play devil's advocate. Borrowing to fund an acquisition that literally doubles your footprint is standard corporate strategy. Why did a 3.9x leverage ratio and a dividend suspension trigger such an immediate, violent panic?
If we connect this to the bigger picture, it all comes down to shareholder demographics. You have to look at who actually owned NCMI stock before this announcement.
Okay.
For years, retail investors heavily owned this stock specifically for its yield. It was an income play.
Right. Cinema advertising is low growth, so they were getting paid to wait.
Exactly. They accepted the volatility because of that reliable dividend. But when you suspend the dividend, income-focused retail investors and mutual funds are literally forced to sell.
Because of their own internal mandate rules.
Yep. The investment thesis just shatters overnight. So by trading a reliable payout for a highly leveraged growth bet, Management completely alienated their core investor base.
And triggered a massive exodus.
Exactly. You strip away the yield, slap 3.9x leverage onto the balance sheet in a high-interest rate environment.
It's suddenly a highly leveraged turnaround play.
Yep. The risk profile totally shifted.
Okay, so with the retail base shaken out, let's look at the corporate insiders and the institutional smart money. How are they positioning themselves?
Well, the insider trading data paints a pretty cautious picture. Over the last 6 months, insiders executed 12 open market sales.
And how many purchases?
0 purchases.
Oof. Give us the numbers on those sales.
CEO Tom Lisinski sold over $900,000 in stock. CFO Ronnie Yang sold $231,000 too, right?
Yeah, and I know executives sell for all sorts of reasons. Taxes, plan schedules, whatever.
But the optics are terrible. Dumping $1 million in equity while quietly negotiating a highly leveraged deal that kills the dividend. Yeah, it definitely signals a lack of conviction from the exact people architecting the pivot.
What about the institutions then? Are they running for the doors too?
That's where it gets interesting because the institutional churn is highly polarized. On one hand, 47 institutions decreased their positions.
Right.
Most notably, SickPal Advisors fully liquidated a 1.45 million share position.
Wow, just totally out.
Completely out.
Right.
But on the flip side, 52 institutions actually added shares. Hotchkiss & Wiley Capital Management added nearly 2 million shares.
So you have massive funds taking totally opposite sides of the exact same leverage profile.
Exactly. Sickle bails, Hotchkiss & Wiley buys the dip. And the crazy part is they're doing this mostly in the dark because management officially suspended all forward guidance.
Specifically because of the Captivate deal, right?
Right. They cited the complexities of partial period consolidated reporting and integration planning.
So what does this all mean? If guidance is dark, what is the best case scenario for investors actually willing to hold through all this turbulence?
Well, the bull case relies on execution. If NCM secures that $11 million in operational savings they're already tracking toward,
Okay.
and they successfully realize the $3.5 million in projected synergies from Captivate,
No. What?
then consensus models suggest the combined entity could actually return to profitability by fiscal 2027.
Projected EPS of what?
Positive 10 cents, with $274.75 million in revenue.
So it's all about whether they can survive the debt burden until those synergies kick in.
Exactly.
Which leaves you with a critical question to explore on your own. Will NCM's aggressive gamble to escape the volatility of the cinema box office ultimately future-proof the business? Or will a 3.9x debt burden crush their cash flow before the synergistic benefits materialize in 2027?
I mean, the margin for error is effectively zero now.
It really is. To follow the execution of this strategy and keep up with all the twists and turns, make sure you follow the show for our daily earnings coverage deep dives. See you next time.